The sound you just heard was the closing of a critical geopolitical window, slammed shut by a sudden severe policy reversal in Washington. The US government has unilaterally revoked a key operating license that had allowed Chevron to maintain and even gradually increase oil production in Venezuela, one of the world's most hydrocarbon-rich but politically volatile nations. This is a dramatic re-weaponization of economic sanctions, transforming a carefully crafted diplomatic opening into a hardline geopolitical hammer. The market's reaction is sober because this move represents an era-defining shift from a policy of managed de-escalation to one of maximum pressure, directly disrupting a key supply source in a tight global oil market and signaling a new, highly volatile environment for every major energy player. The deeper question beneath the headlines is not about oil supply, but about the economic concept of political risk premium, the extra cost investors demand to enter an unstable market. The immediate revocation of this license now tells the global market that, for major US energy companies, political risk is not just high, but instantly changeable and subject to non-economic motivations. This reintroduction of extreme political volatility immediately re-scrambles the global calculus for energy investment, favoring stable dictatorships or highly regulated democracies over politically chaotic regions. The surprising fact is the scale of the operation that was blocked. The previous license had allowed Chevron's joint ventures to produce approximately 240,000 barrels per day. The move to a wind-down license effectively cuts off this substantial supply from a Western company into the Western market, forcing Venezuela's oil to seek buyers almost exclusively in Asia at steep discounts, primarily China and India, increasing the financial lifeline provided by rivals of the United States. This historic parallel echoes the US trade policy during the 1970s and 80s, where targeted sanctions often resulted in unintended consequences by pushing the sanctioned country deeper into the economic orbits of adversaries. For the regular consumer, this matters because it directly injects geopolitical friction back into the price of energy. Behavioral economics teaches us about anchoring bias. Energy prices, once perceived as stable, become volatile again when a major supply source is destabilized. This policy reversal tightens the heavy oil market, potentially impacting US Gulf Coast refineries that are designed to process Venezuela's heavy crude, which translates into an increased input cost that can eventually trickle down to higher prices at the gasoline pump. The decision to block Chevron's Venezuelan production exposes the quiet, fundamental conflict between two competing US policy goals: geopolitical pressure versus market stability. In this move, maximum pressure won, and the structural integrity of the oil market was deemed an acceptable sacrifice. The hidden mechanic behind this policy is the sanctions paradox. The previous license was granted based on the premise that Western presence would allow a Trojan horse for future influence. The revocation, driven by a desire for immediate, tangible diplomatic concessions, operates on the opposite psychological principle. Immediate pain leads to immediate compliance. This creates a state-level version of ultimatum game theory, where the US accepts a short-term loss to coerce a behavioral change from the target regime. The stakes are defined by the global oil balance. The removal of Venezuelan oil capacity increases reliance on OPEC plus supply, effectively handing greater pricing power back to foreign cartels. But here's the part nobody expected. The mechanism used to execute this reversal was followed by a new executive order that threatened a 25% tariff on countries indirectly importing Venezuelan oil. This is a subtle yet powerful mechanism of secondary sanctions designed to punish not just the Venezuelan regime, but any third party that attempts to pick up the slack. This aggressive, multi-layered penalty system mirrors the complex sanctions architecture developed against Iran, signaling a profound escalation in the willingness of the US to use its dollar-based financial power to enforce diplomatic goals. The psychology of institutions is critical here. For big oil companies, the decision fosters an acute sense of regulatory risk aversion. Energy projects require decade-long investment horizons. A political system that can instantly invalidate a multi-billion-dollar commitment based on an unrelated diplomatic dispute makes future investments in any politically risky, yet resource-rich nation exponentially harder to justify. This pushes capital towards projects with lower, more predictable geopolitical risk, which generally means shale and domestic production in the US, but limits the global diversification of supply. For the market, this institutional risk aversion means that the future oil supply curve is structurally less elastic. It takes longer and costs more to bring new, diverse supply online, exacerbating price shocks. The US block on Chevron's Venezuela operations has inadvertently become a global stress test for energy diplomacy, forcing every major power to reevaluate their reliance on American regulatory stability versus sovereign energy control. European countries, and particularly major European energy companies like Italy's Eni and Spain's Repsol, view this US move through the lens of regulatory dependency. The sudden revocation of Chevron's license serves as a stark warning. Their operations, too, are subject not to commercial logic or European policy, but to the often unpredictable foreign policy demands of Washington. This accelerates the psychological drive toward technological sovereignty and resource self-sufficiency in Europe. This global context frames the US action not as a domestic policy choice, but as an act of economic coercion that must be neutralized by increasing non-fossil fuel options. The historical parallel that clarifies this response is the 1973 OPEC oil embargo. The surprising mechanism today is the reverse leverage. The US is now using its regulatory power to exert pressure, but the resulting discounted oil is being eagerly absorbed by China, which is insulated from US financial sanctions by its own vast state-backed trading and financial systems. This creates a powerful mechanism of regulatory arbitrage where the US diplomatic action directly subsidizes its geopolitical rivals. The pressure applied to Venezuela is ultimately transferred into a financial benefit for Beijing, complicating the entire strategic calculus. This matters to global citizens through the lens of power structure insight. The US remains the sole global power capable of weaponizing its currency and legal system to this degree. However, its effectiveness is diminishing as alternative economic systems mature. Behavioral economics refers to this as systemic habituation. The global financial system, repeatedly exposed to US sanctions, is actively developing coping mechanisms and alternative payment rails, de-dollarization, to circumvent the risks. The Chevron block, while effective in the short term, accelerates the long-term trend toward a fragmented global financial order, making all cross-border energy trade inherently more complex, which translates into an unseen underlying cost of doing business. The most profound, non-obvious consequence of the US policy reversal on Chevron is the mandated, immediate strategic response it forces onto big oil, compelling a profound reprioritization of capital and resources across the industry. The mandate to rapidly wind down Venezuelan operations forces a sudden reallocation of billions of dollars in capex, capital expenditure, and engineering talent. Chevron must now immediately pivot those resources to safer, more politically stable regions, primarily the US Permian Basin, Deepwater Gulf of Mexico, and other low-risk jurisdictions. This creates a psychological shift within the corporation. The focus shifts from high-risk, high-reward frontier exploration, like Venezuela, to low-risk, high-efficiency, short-cycle shale projects. This increases domestic US production, but it shrinks the global operational footprint of US majors, making them less diversified and therefore more vulnerable to policy swings within the United States. The system at play is the domestication of US energy capital, driven by geopolitical risk. The part the media isn't discussing is the silent forced boost given to the carbon capture and storage, CCS market, and other low-carbon ventures. Facing sudden, unpredictable blockades on traditional high-profit oil projects, energy majors are psychologically compelled to pivot capital toward investments that offer regulatory stability and guaranteed tax incentives, regardless of short-term commodity volatility. The massive tax credits provided by US legislation for CCS, hydrogen, and biofuels now represent a far more stable and predictable long-term return than a politically exposed oil project in a country like Venezuela. This is not an ideological shift. It is a forced, rational business decision driven by the principle of loss avoidance. The US government, by weaponizing its foreign policy in one area, inadvertently accelerated the energy transition in another by creating a haven for green capital. For workers and communities tied to the energy sector, this means a shift in career stability and geographic opportunity. The need for deepwater drilling engineers and Venezuelan political analysts is diminished, while the demand for subsurface carbon sequestration specialists, pipeline integrity managers in the US, and chemical engineers for hydrogen production surges. This forces a rapid upskilling and geographic movement of a specialized labor force. Behavioral economics points to the salience effect. The highly visible, dramatic policy reversal makes the political risk of overseas ventures immediately salient to every investment committee, ensuring that future capital allocation remains overwhelmingly domestic and focused on stability. The US block on Chevron's initiative is a profound act of economic reengineering, fundamentally changing the risk profile of big oil. Because while the world is focused on the price of crude oil and the geopolitical standoff, the real transformation is already unfolding quietly, and in a place no one expects. The final, critical mass adoption of long-duration energy storage technologies that will truly decouple global power grids from the tyranny of the commodity market.